Between March and April 2016, rebar prices in China went from $300 per ton to $450 per ton, roughly a 50% increase, which took the market by surprise. So most of the people we met in Asia asked us what's happening to steel prices in China. So why did steel prices in China jump? If you think about the sustainability of the Chinese steelmaking as a whole, you'll see that for prices of $300 per ton or below, not only the average cost steelmakers were losing money, but also the low-cost steelmakers were losing money. What this means is that the industry as a whole is unsustainable. So prices had to come up out of that level, but the extent to which they soared was really dictated by other intervening factors. The construction sector shot up early in 2016, increasing demand for steel, right at the time where annualized steel production rates were fairly low, running at some 740 million tons. And this is a full 60 million tons short than the output level of 2015. This tightening in the steel market supported a price increase. On top of this, the availability of liquidity in the Chinese economy due to a previous stimulus of the government meant an invite for speculation in the rebar futures market. And this accelerated and amplified the effect on rebar prices of a better than expected demand for steel products. Once the prices reached the $450 per ton, however, they didn't stay there for very long. Higher price levels stimulated an increase in production. So production rates went from 740 million tons in January, February to 840 million tons in March, April. So this additional supply of steel undermined the support for high steel prices, and prices ended up at the point where they had started of $300 per ton. Once again, we don't think this level is sustainable, so our outlook for the second half of the year is for prices to recover slightly from this low level and settle to a more comfortable, in the more comfortable region of $350, $370 per ton. Many people ask us this question, and the reason why that's the case is that this is not the first attempt at curbing the overcapacity issue in China. And just to give you a measure of the numbers we're talking about a crude steel production last year in 2015 of just above 800 million tons compared to a steelmaking capacity of just below 1.2 billion tons. This means that the level of production only affords a very low utilization rate to Chinese steelmakers, below 70%. And this means that the profitability of the industry as a whole is also poor. So the government has a target that ranges between 100 and 150 million tons of capacity cut between now and 2020. And we think that this time around they will be more successful. And we think this because of two reasons. The first reason is that this time around, together with a host of other measures, the government is also planning to set aside support for the social fallout of the closure of mills, particularly unemployment. And these, in previous attempts at rationalizing the Chinese steel industry, had been a stumbling block. The second reason is that our outlook for prices in the next 5 years is very subdued. So low prices in themselves will create a very strong incentive for capacity closures, particularly for those mills that run at high operating costs and are indebted. However, the process of capacity closures, we expect some 100+ million tons of closures between now and 2020. But this process is unlikely to be smooth. And one of the reasons why that's the case is that we expect price volatility to affect the rate at which capacity is closed. And indeed, this is what happened earlier in 2016, when the high price environment recalled capacity that had been idle in 2015 back into production. In excess of 30 million tons of hot metal production capacity went back into production earlier this year. So it will not be smooth sailing. So in 2014, and even more so in 2015, Chinese domestic demand for steel fell. So what this meant for Chinese steel makers is that they had to find different destinations for their products. In turn, this created a boom in steel exports, reaching the level of 112 million tons in 2015. Just to give you an idea of how large this number is, this is the amount of steel that Japan produces a year, and Japan is the second world largest steel maker. Our expectation for this year and the medium term is that although they will stay at high levels, steel exports from China will slowly fall. And there's two reasons for that. The first reason is that the regions that have received Chinese exports have started investigations and put in place trade barriers against the Chinese producers. So this will make this market more impervious for their exports. The second reason is that unlike 2014 and 2015, when Chinese domestic demand was falling, we expect domestic demand in China to stabilize in the medium term, so this year and in the next few years. This will make for a more predictable environment and will allow eventually export to slowly fall.